This is Chuck Hornevale, and I'm the Chuck in the Markets Up Chuck. And today's blog was titled Playboy, a Financial Fantasy. You know, I saw an article in Barron's where Playboy was up for sale, and the talk was that Iconics Brands was interested in buying the company. As you can see here, this is a company that has a diversified portfolio of some, pretty well-known brands. Fieldcrest, of course, is well-known, and, Joe Boxer, Candies is well-known, Danskin, Starter, etc. But it was kind of interesting that this company would be interested in buying Playboy. But what I found really interesting was the price and the discussions, and then how the stocks have performed as long-term investments. When you look at Iconics Brands from the standpoint of a long-term, relationship to its earnings, you can see the company originally went public, sometime back in the 90s, and they had a real strong rise in stock price. They came out, and then the stock price fell because there was no earnings. And I want you to see very flat earnings went on for, 19 or 20 years here. And what's interesting is, this company has less than $1 billion market cap after 20 years, even though it has all those big brand names. And as a performer, for the last 20 years, it's actually lost money. It's compounded at minus 5% a year during the time when the general stock market did 6.6%. Now, the Barron's article that I blogged about talked about them buying Playboy Enterprise. Now, I was really shocked when I actually ran Playboy's stock price here and put it into the perspective of our earnings fundamental-driven at a glance perspective, because you think of Hugh Hefner, with his robes and his mansion and all the wealth and so on that, you associate with his image. And yet when I look at Playboy Enterprise as an operating business going back all the way to 1991, I find that there was a period where the earnings were pretty strong, I guess, in the beginning here, and the stock price went from split adjusted $5 a share up to $35 or $6 a share. But since 1999, you can see this company has done very poorly for its shareholders, and a lot of it has to do with the fact they really weren't making any money. In fact, they were losing money, and they've never been able to get any kind of consistent earnings growth. And it's really only $142 million total market cap. It's laden with debt, 88% debt, $100,000 invested. Now, it would have given you a modest return, 0.3% a year over 20 years, but clearly not the picture of what you would think of when you think of Hugh Hefner and the Playboy Enterprises. But I think the real message here is, in the long run, it's earnings that determine market price. So, in the final analysis, I don't blame Hugh Hefner for wanting $10 a share for his company that's trading at $4, but I'm really not sure it's even worth the $4 that it's trading at, let alone the $10. But I just, found it interesting because it was kind of a discussion today of where perception and reality really didn't quite mix. And I always would have thought Playboy would have had a much better record than that. Anyway, this is Chuck Hornevale saying, I hope you found this interesting as I have. Thanks for listening. I'll talk to you again tomorrow.